Good afternoon, everyone. Thank you for joining us. We're so glad that you're here at the Finance Magnates Barcelona Trading Conference. So if cryptocurrency is a ship on the ocean of finance and technology, liquidity is the wind in the sails of that ship. It's not immediately visible, and it's utterly vital to the propulsion of crypto trading into the future. Better liquidity has been described as the key to institutional adoption of crypto, to the end of wash trading on cryptocurrency exchanges, and to the success of any cryptocurrency. So here to lead the next panel on cryptocurrency liquidity, I'd like to introduce Michael Pearl, Director of Content at Finance Magnates. Give him a round of applause.
Thank you so much, Rachel. So, market making is probably one of the least spoken facets of crypto, as Rachel mentioned. Everyone loves to talk about which coin will prevail, decentralized versus centralized exchanges, and obviously regulations, but there is far less chatter on how crypto trading is actually done. Or, to paraphrase the famous quote, market making and sausage are two things you do not want to see being made. On this panel, we'll discuss the nitty-gritty of market making and dissolve some myths and misconceptions on the subject. So without further ado, I will allow our distinguished panelists to introduce themselves. So Arpal, please go first.
Right. Well, thank you all for coming, and thanks for having us. I'll tell you a bit about Mint, but first I want to say we're not a market maker. So we're probably the one group, at least that's up here, that's a little bit different. Mint Exchange is actually an OTC ECN that provides, through an exchange format, access to market makers. So individuals or these firms act as service providers in our network, primarily to brokers. So large brokers that are servicing their customers access liquidity to hedge their positions via Mint. So that's what we do. We actually come from the FX market. I'm CEO of a company called Integral that's been doing this in the FX world for about 20 years. And it is that entire FX ECN infrastructure that we moved over to crypto. And we call this Mint Exchange because it's now a regulated entity in the crypto world.
Hi everyone, my name is Charlie. I'm CEO of Wharton. We're a French-based market-making firm focused on crypto. We basically provide liquidity on exchanges. So we post, bid and ask 24/7 on exchanges. And thanks to this access we have on exchanges, we provide liquidity off exchanges directly to professional institutions that want to get exposure to crypto.
Thanks, Michael. I'm Max Bone and I run B2C2. B2C2 is one of the main market makers in the space and one of the oldest. We started in 2013. I was an FX swaps trader at Goldman before. We mostly provide liquidity on exchanges. We're one of the main market makers on the CME. And we also, in I think 2016, we started the first single dealer platform in crypto in order for institutions, retail FX brokers, asset managers, and others to connect. And today we're one of the main OTC liquidity providers as well. We're also a regulated group. We offer a regulated CFD to our institutional clients in the UK. We're based in Tokyo, London, and New Jersey.
Thanks, Michael. My name is Christian Gill. I'm one of the founders of GSR. We also started in 2013 as market makers for Ripple. A few years later, we expanded to providing liquidity to other crypto exchanges. In 2017, we became one of the altcoin market makers. So we provide liquidity to token issuers. In mid-2018, that business was drying up and we pivoted a little bit into the OTC space. By virtue of being plugged into 30-odd exchanges, we're able to source liquidity for people in markets that they can't access. We also have a pretty big footprint in the derivative space. And just last week, we finally booked the first Bitcoin variant swap. So we're really excited about developing structured products to meet the growing needs of a space that is maturing very quickly.
Thank you, guys. So to follow up on the notion of market making not being too familiar to probably quite a few people here in the audience, I would like to ask a very basic question. What are the roles of a market maker in the crypto space?
You want to start?
Okay.
Max.
What's a market maker? A market maker ensures that there's liquidity available, at all times. So you're an intermediary. You intermediate in time between buyers and sellers. So buyers and sellers want immediacy. But unless there's an actual meeting of minds where a seller wants to sell at exactly the same time as a buyer, people don't meet. And so in all conventional markets, they've evolved around the idea that there's going to be specialist firms that provide that immediacy against a spread, because what you do is you show prices on an exchange into an ECN or bilaterally directly to an OTC client. You say that I'm willing to buy at this price and I'm willing to sell at that price, and the price where you're selling is higher than the price where you're buying. And so whenever there's someone who wants to transact, they can do so with you. Now that means that in order to find the other side of that transaction, you need to source it. You need someone else to come take the other side, and that's not going to happen instantaneously. That is a risk that you're taking, because in between the first trade and the hedging, there might be a few seconds, a few minutes, and that means that you need to be compensated for that risk, and that's why you charge that spread. So that's just market making, broadly speaking. But then you've got a lot of different segments. People make markets in different things. You've got the very high frequency market makers that keep the risk for a couple seconds at most, and then you've got people that make markets in more complex products where they're going to essentially take long-term risk that they're going to recycle by splitting it into different parts. Like an options trader will split into delta and gamma and vega and try to replicate the risks that its clients are giving it. It's a big world.
Before you go, Christian, let me focus the question. What are the specific characteristics of market making in crypto, and how does it differ from different other financial industries?
Just to follow up on what Max said, market makers, our job is to create the necessary conditions for people to be able to transact in the most efficient way possible. And as a result, personally, we believe that our KPIs should be, the width of this bid-offer spread that Max mentioned, the depth of the order book, how much uptime we have, i.e., are we really serving this public marketplace by providing best bids and best asks in a consistent fashion? And unfortunately, in crypto, the market-making term gets thrown around quite loosely. There are a lot of people who believe that market makers can generate trading volumes. There are a lot of people who expect market makers to support prices. This, in my view, is reflective of the fact that this is a very young, nascent industry, and being so unregulated, it allows for less scrupulous players to offer services that they shouldn't be offering. I think the space is maturing quickly, and these bad actors are more obvious now. But we still get requests on a regular basis from potential clients asking us how much volume we're going to generate. I'm like, well, I can't guarantee volume unless I do it myself, and that's called wash trading, and that's been illegal since 1933. I can generate the necessary conditions for people to trade a lot of volume because the order book is nice and deep, and the bid offers are nice and tight, and people can get in and out quickly and easily. Did that answer the question?
Definitely. Charlie?
Yeah, you ask what is specific to the space compared to traditional assets. Just if you describe the crypto industry right now, every day you have a new exchange that is being launched. They are all putting new features, putting new user-friendly interface, crazy things that allow you to trade crypto. And once they have done this, they have been working for months on this. They realize two things: they don't have user and they don't have liquidity. And they start being like, what do I need to have liquidity. And one of the answers they get, I don't know from who, but they have it, is like, I need a market maker on my exchange and my volume will go up. Yeah, I think they do, but this is not the only thing they need. And they came to players like us. So I don't know if it's the same business model for every market makers, but for instance, we do it. We partner with exchange and provide liquidity on the exchange, deploy our algo to try to enhance liquidity organically. But as Chris said, we cannot do wash trading. I'm not going to generate 10 million volume a day if there is not enough user in it. So here the incentives you have with a player are very different from the one you have than traditional market. Because the exchanges will be like, put me this very tight spread, be able to absorb any kind of volume, and now you're like, okay, but why should I do this? To hedge the spread you're asking me, I'm going to lose money, and to be able to absorb any kind of volume, it's going to be very cost of funding for me. So here you have to find a way to work with the exchange to make money, because at the end of the day, that's what you're looking for, and for the exchange to be happy with your service. And that's very different from the traditional market, I guess. And so you have to find incentive, and some of the exchanges are finding incentive to make you trade in it, and I think Harpal might have some word to add to this.
So first off, I think your question was, what makes market making different in crypto? So a couple of things. Cryptocurrency trading, generally speaking, is not a highly regulated market. So there are many things that take place that wouldn't happen in more established markets. As a market maker, so I think one thing that's important for people to understand is that the difference between an exchange and a market maker is an exchange is offering a service for the customer to meet other market participants and charges a fee for that. A market maker is acting as a principal and offering a service usually without charging a fee explicitly, and is charging a fee implicitly in the spread between the bid and the offer. So the difference is an exchange acts, so a simple way of describing it, and this isn't going to be perfect, but an exchange acts as an agent and a market maker acts as a principal. When you're acting as a principal, and I'm not saying these guys are, I think, all run very, very reputable shops, but when you're acting as a principal and there is no regulation, you can act in your own interest and there's no one checking you. So market making in the crypto world has a huge variety of behaviors, some of which we haven't seen since 1933. And it can be extremely profitable for some groups, and it can cause a lot of chaos and damage for others. But what I will say as an observer, so we're connected to 22 exchanges and probably have infrastructure that's very similar to what these guys have here in terms of supporting their own businesses, except we offer this up to the customers as a service. What I can say, at least from our perspective, is the market is improving in terms of the cleanliness and the transparency of the behavior extremely rapidly. Mostly because of economic factors, economic forces, meaning that if people are misbehaving in the market, they just can't continue to function, because OTC markets, the way they operate is that if somebody's using a service and it doesn't work out well, they'll use someone else. So the market is cleaning itself up. And I think folks like the ones that are up here on stage, are much more likely to be the long-term survivors, because they are up here speaking publicly. People know their name. They have a website. People talk about what's going on. I think the web has done a fantastic thing of people's reputations, and so on. But that's I think something for people to understand.
Just to focus you on that, Christian, you kind of hinted on wash trading, gently hinted. Many people view market makers, and obviously not this distinguished panel, but there is some image of alchemists. They take blip coins and turn them into gold. So, and you talked about exchanges that are not worth that much in terms of actual liquidity, that are generating crazy volumes all of a sudden. So, can you give us more details about the practice of wash trading? How common is it? How is it actually being done? And what can we see in the future? Because you were talking about the market becoming cleaner. So are we really moving in that direction?
Yeah, I agree with Harpo. The things have improved. I think it's a shame that we came out of crypto winter so quickly, because crypto winter was really helping to flush out all these bad actors. You know, just one point, the crypto exchange space is extremely crowded. I would guess that there's less than 10 that are really making money today. And there are hundreds out there. And some of those that don't make my top 10 trade hundreds of millions of dollars every day, or at least they report them. In terms of how wash trading happens, well, I mean, wash trading is simply, you know, trading with yourself. There's no actual economic transaction taking place. The reason token issuers ask for it and exchanges allow it is because I guess they believe that it's better to be ranked higher in volume rankings. It gives them more visibility and it makes them more attractive to retail traders. But it's fundamentally dishonest. You're painting a picture that's not true. The exchanges are happy to allow it because it makes them go up in the rankings. And it also generates a tremendous amount of money in fees for them, right? With the exception of when the exchanges allow people to trade paying no fees, which is even more blatant. We've seen, you know, we've been making noise about this for a couple of years now, and I think in the last 6 months, there's been a whole bunch of different reports coming out. I think Bitwise probably did the best analysis, and I appreciate that it's a little self-serving, but they did go into depth, and I think their list is as close as anybody has come to reality. But there are other dark forces occurring in a lot of these unregulated exchanges. It's not just wash trading. One other very big problem, the way we see it, is the fact that on most of these venues, you don't have a level playing field. And level playing fields are what real markets and, you know, in the real world of finance, where we all came from, are built on. When certain actors are given advantages over the rest, that just doesn't work long term.
Max, you want to add to that?
Yeah, that's actually very interesting that you talk about the level playing field. Well, personally, I think that, you know, market making and liquidity, there's really different segments, and some people call themselves market makers. They're not really market makers. And you've got, yeah, that sort of dark side to the industry where you have like those Chinese exchanges that have fake volumes and things like that. That makes my life difficult because I don't really know what exchange I can connect to and know that they're going to be, you know, for real. So I try to simply stay away from all that stuff. But when you touch upon the idea of a level playing field, there's something that is I quite like about the crypto market is it actually mostly is, for now at least, a level playing field, because anyone, you know, two guys in a garage, and that's how we started a while ago, you know, you can connect to different exchanges and you can start trading and maybe have alpha and you can make money. So that's really good. But there's a big risk actually that the crypto industry goes the way of the conventional markets, where it's not that it's not really a level playing field, but that the bars to entry are so high. So I can reveal a number. I'm paying not far from $1 million a year in infrastructure costs. Why? Because I need all sorts of servers, collocations, and dedicated lines and stuff like that. It is super expensive. If you want to come and compete with me, there's no way you can do that under a sort of fixed cost of $200K a year in infra fees, right? So that's just crazy. In conventional market, that's even worse. You know, we're talking, you know, some of you might know the Hibernia line across the fiber line across the Atlantic. It's over $200,000 a month to rent it. And if you don't rent it, you can't compete on the lines that, you know, let's say the New York Stock Exchange versus Frankfurt. There's just no way. And I think there's a risk that the crypto market goes in that direction, that exchanges are going to start to, you know, force you to pay for data and things like that. And that in order to compete as a professional trading firm, be it a quant fund or a market maker, then you're going to have to start paying, you know, more and more and more just to participate in the game. And I think that there's a few firms that are actually trying to push back against that. And for all that, you know, people maybe don't like about Binance, Binance is one such company that really understand that they depend on a lot of retail users in China and other places to trade on their platform, and so they actually actively try to discourage behaviors that are typical of what you would see in conventional HFTs, such as, like jumping, closing the spread as soon as someone puts a resting order close to mid and things like that. And I think that can be a good thing, because there's a serious risk that, a couple of years down the line, it is impossible to start a crypto trading firm without at least $10 million in capital.
So Arpal, you, as you mentioned, you're an FX veteran with quite a few decades in the industry. The FX industry is much more based, much more regulated. Where do you think all this is headed? I mean, what kind of tips and suggestions can you suggest to the cryptocurrency market makers what lessons can you draw from the Forex industry that can, benefit the crypto industry?
Yeah. So I think there are some aspects of the crypto industry that are following the same pattern of the FX industry at probably 4 times the rate. So what took 20 years in FX is probably going to take 5 years in crypto. So and we've all seen it from 2000 until sort of 2020. We started with single dealer platforms. We started with request for quote. We moved to executable streaming prices. We moved to down to perfect price discrimination by tagging customers and all those kinds of concepts. Which is now an extremely modern market in FX. So there are some aspects where crypto is significantly behind and it's following the same curve, and it's going to continue on that path. Interestingly enough, and this is a point that Max had raised earlier, there are some aspects of crypto which are significantly more advanced than FX. And one simple issue is access to primary markets. Now, not that there's any market in crypto, maybe with the exception of BitMEX, which is a significant liquidity pool market. But the fact that as long as I don't live in the United States and blah blah blah, all the other disclosures on none of us can legally trade in BitMEX, but BitMEX is the largest market in the world in which we all trade. The fact is, if I have the right proxy server, I can set up an account and trade on BitMEX in less than 10 minutes. I can't do that in the foreign exchange market. I need to have a prime broker. I need to have, to trade in the interbank market in foreign exchange, you need to be a tier 1 bank, or you've got to rent somebody else's balance sheet. So there are aspects of the crypto market which are significantly more advanced than the FX market. And it has something to do totally independently from markets. It has to do with credit. And this is the beauty of the digital aspect, the decentralized computing, the blockchain technology space that digital assets are related to, but live in this sort of, in some ways an orthogonal world, right? And we get things confused. To talk about, just as an aside, to talk about security tokens and blockchain decentralization and the price of Bitcoin are 3 totally unrelated things, but we all talk about them in the same conference somehow. In this particular case, the idea that you have a decentralized ledger, which is part of the settlement mechanism, and implicit, escrow mechanisms, but from the use of certain intermediaries who are essentially open to everyone, is a level of openness and transparency in this market that none of the established capital markets have, right? So the final answer to your question is, I think there are things that are going to be developed in this market that FX and fixed income are going to learn a lot from, like distributed, decentralized custody, like peer-to-peer lending, like derivative products, whether the governments allow us to legally create them and trade them and so on or not. The rest of capital markets is going to learn from, and this market will learn from a lot of the things that we're talking about here. The cleanup that we're going through, we will learn from the established markets.
Interesting. So, Charlie, I want to ask you, we mentioned the crypto winter, the bear market, and so on. How does it affect, we all know how does it affect the exchanges, but what are the implications of a bear market on market makers?
So the answer will depend from one market maker to another, and it will depend on the way source is funding. For us, for instance, most of our funding is either in fiat, either in crypto. So let's say I'm market making BTC against USD. My funding comes from USD and my funding comes from BTC. It's a loan that I have to give back at the end of the year, to make it simple. The fact that BTC is going down doesn't make me lose BTC. So of course, it's not something that I wish at the beginning of the year to say, okay, I want BTC to go down by 19%. Of course not. It means my spreads will be lower. It means volume will be lower. On average, the interest coming from institutional will be lower. So of course, for business is not good, but it doesn't necessarily mean that the valuation of my book, of my company, sorry, will be decreased by the decrease of Bitcoin. So, and Chris was saying that he was a bit disappointed that crypto winter went gone so fast. Actually, I think it's a very good point because it hasn't been a good year, 2018. I'm not talking for the others, but I think I can. It hasn't been an amazing year in terms of business, but it hasn't been as harsh as it has been for other players, like maybe investment funds that were long Bitcoin or something like this. A market maker is not necessarily long for the asset is trading. So depending on the source of funding you have, it's not necessarily a nightmare to see the price decrease, even if, of course, on average, it's not good for business.
So speaking of, Max, you want to take that, or?
Yeah, I can only speak for my business, but you have to separate two things, two problems that are actually orthogonal. As a market maker, you don't need to be exposed to the price of crypto. My firm is not exposed to the price of crypto. We're in the business of showing prices at a spread that is stochastic, and you hope that on average you make more money than you lose on adverse selection, and that's what it is. It doesn't matter the market that you're in; it's the same story everywhere. Now, whether your firm is or not long crypto as a whole is completely separate. Some exchanges are long crypto, some exchanges are not. I like Arthur from BitMEX because he's very, very much a Bitcoin skeptic, and every time he gets the fees, every day he sells them OTC. I really like that approach. So it's kind of two different problems. And one reason I'm totally with Chris here that I wish the crypto winter had lasted longer is because all those firms that have attached their cart to the wagon of Bitcoin, they got flushed out in the crypto winter, and had it lasted a little bit longer, we would have had, I think, a healthier industry. Now, you look at an exchange. What is the problem for an exchange when crypto goes down? Well, if they're long Bitcoin, they lose a lot of money. But also, you have to understand that exchanges significantly ramped up their operations in 2017 because there was so much money on the table, they wanted to go after it. And so you're looking at an exchange like one of the big ones, Coinbase, etc. Their costs are of the order of $100 million a year. That's how much they're spending. And so when volumes go down 80%, then they have that incredible operational leverage that makes it so that, in 6 months, they're just gone. So a lot of exchanges are really, really lucky that mid-2019, we had a big rally. Back in 2017, actually, Coinbase was almost going bankrupt. They were so lucky that we started having that big rally because they were just spending too much. And so that's the problem you see with the exchanges. They need to have a heavy operational footprint, so they have high operational gearing, and when things turn sour, they don't have the fee generation capabilities to survive that for long.
Can I say something about that?
Yeah, shortly.
I think there is a very important shift that is about to happen in this market, and part of it is going to be about terminology. Many of the firms out there in crypto that call themselves exchanges are not exchanges, they're brokers. They're just brokers, but because there was no underlying liquidity for them to access, so there was no futures market for them being an FCM, there was no interbank market for them to be a broker, they had to create liquidity from somewhere, and they would set up these primitive matching engines and a lot of other things that we consider, the simple word for it is junk, on the back ends of their systems, but they're just brokers. So what we're actually seeing is, as this market matures, we think there's going to be a massive proliferation of brokers, and believe it or not, the cost of setting up a new brokerage operation is going to fall down to zero. Why? Because there is going to emerge the existence of real exchanges, like us. we're just an exchange. We don't open retail accounts with people. Our customers are the large brokers who are getting out of the exchange business entirely. They're plugging into, and I mean, we're sponsored by brokers, right? So FX brokers that moved into the crypto space recognized very early that they don't want to actually run a matching engine, they just need to access liquidity. But if they want to access liquidity of the entire market, they were going to go to an OTC ECN that was already doing that in FX and say, please do this for us in crypto, which is why we set up Mint. So the existing crypto exchanges, who we believe are actually just brokers, are going to realize very quickly, and they're already starting to realize this, that they don't need to run matching engines back there. They should just be brokers. They should have the relationship with their customers. They should extend credit. They should, service their customers as all brokers do, but then tap liquidity generally from folks like these, but via a mechanism who is acting as a service provider to them, an agent, an exchange. And as the model moves to that, there'll be 1,000 more brokers that get created in the market, and that's fine, because that's demand aggregation for you guys. And as long as you can tap them, if you can tap those millions and millions of people, that's totally fine.
Interesting. So going back to...
I got him to nod his head, yes. That's the way.
We made headway. So going back to drawing the lines between FX and crypto, in the FX world we have what is called a code of conduct. And it took many, many years to get to that point. So Max, you were telling me about an SRO that you guys have set up. Not Max, sorry, Christian. You told me about the SRO that you guys set up. Can you expand more on that? And where do we expect to see the market? Are we headed towards like a single code of conduct for the crypto industry?
I really doubt it. That's going to be very difficult. The SRO you're referring to is called the Atom. We set it up alongside some other large crypto firms like Galaxy and Cumberland back in May of last year. As we were starting to enter the crypto winter, we had some time to think. And the idea is simple. There is no rule book in crypto. The regulators are far behind. And those of us who come from places where we have been regulated and the rules are clearly defined, well, we thought we would try and implement similar type of rules for ourselves. How to from things as simple as identifying bad actors who we all come across in the wonderful OTC space of people broking 100,000 Bitcoin deals, to establishing standards when we're trading options bilaterally. We don't need to keep reinventing the wheel in crypto. All of this stuff has been done time and time again. And it's just not rocket science to just try and implement similar guidelines in what we do every day. And the idea is that when the regulators finally are ready to put something to ink, well, we've set up a playbook that we've been using. These were our best efforts. Sorry if we screwed something up, but this has been working pretty well. Hopefully this helps and we can move along faster.
Max, you wanted to add to that?
Yeah, it's good you're seeing the emergence of SROs. So Adam's one, there's GDF as well. I think it's good, but as Chris says, we're not reinventing the wheel here, and it's very important. Also, we're lucky, just as Apal hinted at, economic forces are pushing us towards a different way of doing things. So I think that, the different microstructures that we have, you say that exchanges are brokers. I think on top of that, they're clearing houses. That makes absolutely no sense. And so economically, because of the value from a balance sheet perspective of post-trade settlement, we're going to move towards a separation between clearinghouse, exchanges, brokers are going to be another one. From a very microstructure perspective, central limit order books make no sense for most use cases, and that's what you see in FX. There's really 3 real exchanges in FX and everything else is OTC. The OTC ECN model makes a lot more sense. So that's something we're starting to see slowly. Some aggregators are emerging in crypto. Mint, I guess, is in that space, also Tagomi. It's quite interesting, and I think that it's going to move really fast. One of the predictions maybe I can make for 2019 is that one of the large exchanges, not one of the biggest, but a non-minor exchange, is actually maybe going to turn off its central limit order book. It makes no sense. Maybe, perhaps not a Coinbase, but someone like that. In fact, Coinbase just spent $50 million, I hear, on a matching engine improvement, and they just fired everyone in Chicago and just forgot about that. Because they understood that the value in Coinbase is in the 20 million users. It's not in the tech, it's not in the matching engine. And so they're understanding they need to cater to their base, and they need to let others focus on the microstructure or getting the liquidity into, to the end user. And I think that that's going to happen very fast, but also, because of economic forces, not because, some regulator tells us to do it.
So we're moving towards the end of the panel, and we cannot conclude the panel without raising the word Libra, right? I'm just curious, how will it look like? How will Libra trading eventually look like? How will liquidity for Libra will look like? How will the coin be launched on the various exchanges? And is there any difference to other more traditional, so to speak, cryptocurrencies? Charlie, you want to take it? By the way, speaking of 2 million users, we're talking about 2 billion or 4 billion or God knows how many users.
2.7, yeah.
That's not the easiest question, I guess. Thank you for asking me first. The most honest answer I can give you is that I'm not going to trade it. And I think that's my answer. I'm not going to trade it. I need to see how it looks like. I need to see which player are holding it. I'm not able right now to do it, and I will not take this bet in a short future to say that I'm going to trade it. And I'm not even sure it will be tradable, first of all. But I'm not sure how it will look like and everything. And I'm not going to add this asset to the asset universe I'm trading or I'm proposing to my client, because I have no idea how it will look like. And I think it's important to say it like in a very honest way, because either way it means we are full of you know what. So I'm not going to trade it.
I'm going to cop out here quickly because for business reasons, I don't want to comment too much on Libra. I will say that I think
you want to share something with us?
No, not at all. But I will say that it's obviously fantastic for crypto as a whole to get this much visibility, even if it has pissed off all the regulators in the world, or at least scared them.
If there's volumes to be had and spreads to capture, we will trade it at B2C2. However, there was a very interesting tweet, quite funny, when it came out. It was along the lines of, imagine a coin with the compliance controls of Standard Chartered and the privacy protections of Facebook. Wow. So I think it's potentially a disaster in the making. However, they're a big firm, so maybe they can make it work.
So I'll go out on a limb here and say that I don't think Libra, as it has currently been defined in the white paper and the direction that it's currently described as, will ever trade. All it has done is created a conversation that the regulators now recognize that they don't want any threat to their sovereign, their sovereign currencies. B, they are really going to look at the AML KYC on a global basis. So I think regulators' antennae are up. And that's generally a bad thing because they may throw the baby out with the bathwater, and that would be bad. So I think Facebook has caused a lot of damage doing it the way they've done it. They will probably never do anything like this. This will never get to market. The good side is that people are now really interested, and they want to try to understand this and understand why it's bad, and there'll be a lot of learning that will happen. I think at the end of the day, WhatsApp will release a fiat token in the respective countries that WhatsApp operates in, just like WeChat, just like every other messaging platform that has some payment mechanism. The thing is, Facebook is so incompetent. They've done this 4 times before, and every single time it's failed because they have such poor operating execution people. And being 2 miles away from them and knowing the guys that are there and knowing the guys from PayPal who have gone over to do this, from our perspective, it's really obvious why this happened. They're not good, they're not competent. But they are the incumbent with 2 billion users, so they'll keep trying stuff. But everything they try shows up in the news. So that's why it's not a surprise that it's like so bad. But I think the real thing that's good for all of us is that this has re-engaged the public. I think there will be lots of really interesting smaller versions of payment mechanisms that are based on blockchains and decentralized consensus that will emerge out of this, and that's a good thing.
Okay, so unfortunately we have to conclude the panel. We have time for a question or two. Anyone? Going once, going twice. Oh, sorry. Please use the microphone over there.
Yeah, I just have a general question for probably all the market makers there. When you market make onto an exchange like Binance, etc., what is your exposure to that exchange? If they go bust tomorrow and all their coins are stolen, is that a material hit and you're out of business? It's a negative impact? Or if it's not affecting you, how do you manage that risk?
So I'll speak to that because I've went through several exchange bankruptcies. It's obviously bad, right? Because you're exposed to the full amount of the funds that you have in the exchange, which can be a lot of money. Something that is not public, but I'll say it here. Coinbase had $1 million on Bitfinex when they went bankrupt. Why? Because they were, operating as a sort of broker, but at the same time an exchange. So they were getting prices from Bitfinex that they were remarketing on Coinbase when the liquidity there was low. So it was terrible when it happened for them and for a lot of players. Now, the thing is that exchanges being a clearinghouse is a bad thing. And the way that normal markets work is you have credit agreements with a prime broker or, well, the CME via your FCM if you're trading futures. And that's how things should work. You should never be exposed for the full amounts of the funds that you have on a trading platform. You should not have funds on the platforms in the first place. So what we do as market makers, and I'm sure my colleagues here do the same thing, is that you negotiate credit agreements with the exchanges so that, if you deposit $1 on the exchange, you're going to be able to lever it up to like $2, $3, $4 if you want, because the exchange is essentially going to lend you some capital in order to trade on their platform. So that's how the market has made it work, because if you try to get credit out of the door, it comes back through the back door. There's just no way to escape credit constraints in any market, and so you found that the crypto market started with no credit and that it kind of crept back in, and that's where we are. But it's not a good state where we are, but it's going to change.
Anybody else want to take it, or we're moving to the next question? Okay, anybody else? Any other questions? Please.
Gemini has the best technology. It's a shame they don't have the volumes that come with it.
I asked our CTO that question the other day, and
Yeah, can you repeat the question?
Yeah, the question was, are there any exchanges out there that have surprised you one way or the other? And I was at a dinner party with our CTO. Somebody was interested in maybe launching an exchange, and I asked the CTO, which one of the 34 that we're plugged into behaves the best? And he says, you're not going to like this. Hit BTC. With all the hair that comes with.
My CTO wouldn't have said the same, so you see it depends from market makers to another. But there are some that are trying to mitigate the risks that the other person were talking about by trying to be non-custodial or this kind of thing. And we've seen some players managing to do that, and that the liquidity is not there. But that's maybe a play to take in the coming years, trying to find different way. exchanges are not built to do everything. Right now, they are doing everything. They are keeping your money. They are showing you prices. They are giving you the infrastructure. At the end of the day, it shouldn't be like this. So the ones that are trying to focus on what they know how to do and maybe take out some of the risk are the ones that we love.
On the flip side, you'd be surprised as to how hard it is to get real data from an exchange like Binance, right? With all their retail users, and you have to ask yourself the question, why is that? Another thing that's surprising, and I'm sure Max, you felt it, is BitMEX's matching engine, right? Here we have the largest exchange in the world, processing billions of dollars a day, and somehow they still have a matching engine that gets overloaded every so often.
So unfortunately, we're out of time. Thank you all so much, and enjoy your time.